Jamie Dimon, the CEO of JPMorgan Chase, is sounding the alarm about a looming economic hurricane. He cites rising inflation, higher interest rates, the war in Ukraine, and debt crisis as some of the factors that could lead to a recession. Is Dimon right to be worried? What can you do to protect your finances? Hello, and welcome back to Serious Coinage. In this video, we'll look at Dimon's warnings and what they mean for you. We'll also discuss some of the things you can do to prepare for an economic recession. So, if you're concerned about the economy, don't miss this video. We'll give you the information you need to make informed decisions about your financial future. Since 2005, Jamie Dimon, one of the most visible and acclaimed CEOs in the world's economy, has successfully steered JPMorgan Chase to become the largest non-state-owned bank in the world. The CEO, currently worth roughly $1.7 billion, is a superstar in the executive domain of finance and a master of macroeconomics. For example, he seems to have led JP Morgan through the pandemic recession and the subsequent instability with the same degree of comfort with which he led the company through the 2008 financial crisis. Whether you find him repulsive, annoying, or fascinating, you should listen to what he has to say because of his vast understanding of macroeconomics and access to cutting-edge research data that we cannot even begin to fathom. In his address to investors at JP Morgan Chase's Investor Day on May 22, 2022, Jamie Dimon gave us our first inkling of a prolonged period of economic uncertainty and hardship when he said, "I'm calling it storm clouds because they're storm clouds. They may dissipate." Similarly, on October last year, Jamie Dimon warned that the United States and the world economy may face a very, very serious combination of headwinds that may cause a recession in near future. The CEO of the largest bank in the United States pointed out that the U.S. economy is actually still doing well, and that customers are likely to be in a better situation than during the 2008 global financial crisis. But you cannot talk about the economy without talking about the future, and this is serious stuff, Dimon said on Monday at the JPM Techstars conference in London to CNBC's Juliana Tatelbaum. Among the warning signs, Dimon listed the impact of runaway inflation, higher than expected interest rates, the unknown impacts of quantitative tightening, and Russia's war in Ukraine. He claimed that these are really major issues that will push the United States and the rest of the world into recession by the end of 2023. His remarks come at a time of growing anxiety about the risk of an economic recession as the Federal Reserve and other major central banks raise interest to combat skyrocketing inflation. When asked about inflation reaching 4-decade highs, Dimon said the Federal Reserve waited too long and did too little, but that it is clearly catching up. Although it would be foolish to assume that he doesn't have an agenda behind his public statements, it would be just as foolish to disregard everything he claimed based, as this would cause us to lose a lot of money in the long run. Guessing is tough, so be ready. Dimon stated that he was unsure of how long a U.S. recession may persist, and that market players should instead evaluate a spectrum of possible outcomes. The outcome of this battle will have a significant impact, and its severity can range from light to severe. So I think it is difficult to speculate. Prepare yourself, he said. Dimon stated that the one thing he could count on was for the market to be erratic. He also cautioned that this could happen at a time when the economy is in disarray. Is Dimon right to be worried? The current economic outlook is widely believed to be favorable. Spending by consumers has increased, growing by 7% to 9% from the previous year and 23% from pre-pandemic levels. In a letter to shareholders dated April 4th of this year, Jamie Dimon estimated that people now have $1.2 trillion more cash available in their checking accounts than they did before the pandemic. Since the unemployment rate has remained at 3.7%, below the long-term average of 5.7%, and the all-time high of 14.7% in April 2020, most people have concluded that the economy is doing well. That's on top of the fact that in April, businesses in the United States added a total of 250,000 jobs, which is 40% higher than what the market had predicted would happen. Wage inflation of 6.1% in April 2023 is higher than the 4.9% growth in the Consumer Price Index, CPI, suggesting a healthy labor market in the United States. From the perspective of someone who exclusively consumes legacy media such as Bloomberg, CNBC, etc., the economy is doing splendidly and there is no need for alarm. But obviously, this is all an act. Market expectations were drastically altered by the large failure of financial firms like SVB and Credit Suisse and the subsequent comments by Jamie Dimon. Since necessities like food have increased in price by 6.7% over the past year, housing costs have increased by 8%, and transportation costs have increased by 11%. Real CPI is higher than one might predict from headline inflation numbers. If inflation is higher than the market rate, the wage growth must keep pace with it to keep up with rising consumer expenses. Otherwise, rising inflation will push up production costs, which will push up consumer prices, which will push up inflation even more. Due to stagnant wage growth, this is already happening in the US economy, albeit at a lesser rate. And this problem isn't going away anytime soon. And it won't go away until the Fed finally stops raising interest rates and so stops the economy by triggering a widespread decline in consumer spending. In addition, he further predicted that individuals should expect high interest rates as there's a chance that long-term rates may rise and that people will become acclimated to hiring for longer. Capital outflows from the stock market and equities in general are virtually guaranteed if we accept Jamie Dimon's prediction that interest rates will remain higher for longer. Federal student loan debtors will have to resume payments on August 30th after the Supreme Court found it illegal on June 30th. This comes after more than 3 years of pandemic relief attempts. An occurrence that will force 43 million borrowers to reevaluate their financial situations and make sacrifices to repay the $1 trillion in outstanding student loan debt. On a smaller scale, it will reduce the wealth of nearly 43 million Americans by $4,800 a year, based on the average monthly payment of $400. How could consumer spending possibly be worse? The Americans have been saddled with other forms of debt as well. The latest consumer debt data from the Federal Reserve Bank of New York shows that the first quarter of 2023, Americans' total credit card balance was $986 billion, remaining unchanged from the record number set in the fourth quarter of 2022, and making it the highest balance since the New York began tracking in 1999. The FED's data on juvenile delinquency, among other things, is alarming. The proportion of outstanding credit card balances that are more than 30 days past due increased from 2.25% to 2.43% in the first quarter of 2023, continuing a trend of 6 consecutive quarterly increases. For the past 15 months, the total amount of outstanding credit card debt has increased alongside the monthly rate at which payments have been missed. This indicates that, overall, debt is increasing, and its maturity date is drawing near. Pandemic debt reduction and debt cancellation periods are over, and repayment is required. No one can or will be able to keep denying this fact forever. If they keep spending at the same rate, they will become much more impoverished than they are now. The economy is overplump and must be reduced in size. For U.S. markets to return to normal, they must absorb over $2 trillion in insecurities. It's crucial to act before this tipping point is reached because, once it's reached, chaos will ensue rapidly. Dimon's warnings have been met with mixed reactions. Some people believe that he is overreacting, while others believe that he is simply being realistic about the challenges that the economy is facing. The truth is that it is impossible to say for sure whether Dimon is right. However, it is important to be aware of the risks and to take steps to protect yourself in case of a recession. Thank you for watching, and don't forget to hit the notification bell and subscribe for more.